Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveny. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome, everybody, to another episode of the Creating Wealth Simplified podcast. I'm your co-host, Chris Seveny. Today, we have a special guest. We've got a full-time real investor who's managing partner with family with Valkyrie Investment Group. We have Chris Levarek. Chris, how are you today?
I'm good. Thanks for having me. Appreciate it.
Yep. So Chris is out of the Southwest, out of Phoenix. So you're probably getting a little better weather than I'm getting here in the Mid-Atlantic region and so forth. But Chris, why don't we just start off telling us a little bit about what you've got going on today?
Sure. So today I run a 506c fund, accredited fund. Got a couple deals in there. We raised for multifamily and we do short-term rental offerings in there. And then I also teach short-term rentals. So if you don't want to be a passive investor, you want to go do it yourself, I actually have a course and a coaching program. That's
Cool.
really the gist of it.
So before we roll back to how you got invested, I love asking this question because I'm curious if your results are similar to mine. How many people, after taking your coaching program and buy one or two assets, turn around and basically just invest in your fund after the fact?
After they learn how hard it is?
Yes.
Well, we just launched our program, so I don't have a lot of the data yet, but it's true. Like people, as soon as they see it's not all just rainbows and butterflies, they want the hands-off approach.
So funny story is when I started, we do a lot of mortgage note investing and people would ask, where were you getting your investors? I'm like, from investors. I'd go find out who's taking the same class as me. We're all in the same webinar. And I'd reach out and I'm like, hey, if you ever not want to do this and just partner with somebody and have them do all the work. And most people realize like, if you've only got like $20,000 or $50,000, okay, I can go make 15%, but I'm going to make $3,000 to do how many hours of work where I can just give somebody this money and still make about the same? Like, let me think about that.
That's a great idea, actually.
So real estate, a little bit background, how you got in real estate. I know you're a former firefighter in the Air Force, went to ASU and so forth, but where did the passion for real estate come in?
Yeah, for sure. It happened a lot. I was in an IT corporate career after I got out of the Air Force, about 12 years. I was an engineer, rose up in the ranks, dumped a lot of money into a 401k. And really that idea that setting yourself up with a retirement plan for me in 2018, literally in 2018, I remember they were actually tweaking with the Fed rate back then, and it caused a dip in the market, kind of like what's going on right now. And I remember looking at my 401k and like $10,000 was gone in a day. And I was kind of like, well, that sucks. Like, what happens? Is it really going to be there when I'm 67 or whatever? So that got the wheels turning. I was listening to Bigger Pockets back then. I had a 45-minute commute one way. So it was plenty of time. And went and bought my first duplex in North Carolina. That's really where I started. So I bought remote out of state was my first deal. And I partnered with a private lender on my first deal. So every deal I've done actually has never been just me. It's always been a partner of some kind.
Okay. So you're pretty brave. First deal across the other coast on the East Coast. Did you ever visit the property? You buy it sight unseen? What was that process like?
So I've only visited it once, but it was long after I owned it, the original property. So my brother was 3-4 hours south of that. So I guess we were like, okay, if it hits the fan, he was by Fort Bragg, which is Fayetteville. We bought in Durham, so about 3 hours north.
Okay. And do you still own that rental today or did you liquidate it?
Sold the first one.
Okay.
The first one was really a stinker. 1940s, 2 duplexes, C-class housing, Section 8.
So get somebody in there, have to evict them and then spend 10 grand to rehab it?
Yeah, pretty much.
So I rarely buy duplexes and so forth, but anytime you hear a C-class rental and somebody says stinker, that's pretty much what happens. When you penciled it out, though, when you're looking to buy it, how did the numbers look at that point in time?
Back then, we didn't know. We did not put enough money for renovations. I think we were doing like 50,000 renovations for 2 duplexes, actually. Ended up being around 90,000. So we were off the mark by a bit. However, we did the Burr approach. And as far as a Burr, it was a solid deal. We got all our equity back out. So it was just so run down. I think that you could have put easily another 50,000 into it to make it a lot better. But it worked. We got our capital back. That was really our goal, is how do we scale this? How do we get our equity out?
So that was the first deal. And what drove you to keep going? That sounds like you don't seem to be the type of person who would give up after the first try anyways. But what was your ambition to keep going? Was it, hey, lesson learned and I've picked up some experience from this and now I'm a little sharper and I'm starting to learn a little bit more about what I don't know? What was your mindset at that point in time?
Right. So I think when you start, you're like, I'll do one or two deals and I'll be set. I'll quit my job because you just don't know. So when you do those duplexes with the Burrs, you're going to make like $100 a month, maybe cash flowing, especially if you pull all your equity out and you have a high loan leverage point. So from that, I was like, I got to do 10 more of these just to even like close to scratching the surface. So we jumped back into the next one and figured we could do better on the next duplex. So we did another,
So quick question for you, because it popped in my head, because you've done a Burrs, I've done some Burrs. When I was doing them, interest rates were, one of my Burrs, I have a 2.5% interest rate on a 15-year loan that I started in 2013. So that one matures the same year my son starts college. So lo and behold, I will have another property paid off if I need to use that for college. But I'm curious to your opinion, Burrs going forward, is it actually going to be something people can do and scale at 6%, 7% interest rates? I'm curious your thought on that.
Not unless they get a really good deal or really find it off market, especially right now, because a lot of the sellers are just so positioned from the 2021 run that they really think prices should be a certain level. So sellers are going to have to come down a bit, but before interest rates could even come close to that kind of thing. And I tell people too, like the Burrs are good for a legacy wealth play, but nowadays they don't really cash flow anyways. But even in like the olden days, I would argue that if you're pulling all the equity out, you really need a good deal for it to be cash flowing. Typically, the higher your mortgage is going to be, the more expense you're going to have. And then is it really fulfilling what you're trying to do? If it's a legacy play, then yeah.
And for people who aren't familiar with the Burr, it's you buy, rehab, rent, and refinance and try and get all the money that you put into it back out. And ours, that was it. Ours was a legacy play that we knew we were going to hold. Originally, it was only cash flowing about like $20 a month, but somebody was paying all that principal down on it. That was okay. And now it cash flows about $300 a month. So if you hold it over time, of course, rents will go up. And as long as it's not in an HOA that have fees, if you got a fixed mortgage, rents will eventually go up, probably a little higher than your expenses on those. So, like I said, long-term hold, if you ask anybody, the longer you hold real estate, typically the better off you are. But so you were doing some rentals and so forth. Then, so what got you into the short-term rental game?
Yeah, really, it was trying to have cash flow for my business originally. So I got into syndications and I got these longer term hold plays. And so we're waiting like 3 to 5 years for our cut. We're trying to value add an apartment, for example. Well, the first 2 to 3 years, you're spending all that 2 to 3 years either paying investors or making it stabilized, getting that property to be cash flowing. So typically the owners or the GPs, our general partners, are really not getting much till the end. So I couldn't run a business like that. So I needed an asset that cash flowed a little more, was more a cash flow play, not as much an appreciation play. And short-term rentals are that. You can do interest-only loans and 10-year interest-only loans and get a cash flowing asset that you're not paying down the property as much and all that kind of stuff, but you got money for the business, and that's why I teach it too. Cause I'm like, well, it depends. Your goal is to get cash flow to scale. I think a short-term rental play is actually very efficient early on.
Now, have you left your full-time job?
Yeah, I quit last March, actually today, coincidentally enough.
Wow. Congratulations.
Thank you. Thank you.
So on the short-term rentals, I love talking about this because short-term rentals are a little bit of a little bit heated debate on some of them, and people love them, hate them, some people. And again, there's so many different aspects of short-term rentals. There's the people who will basically go rent an apartment in New York City and then try and sublease it as a short-term rental and arbitrage your rent. That is one aspect, which can be very high risk, high rewarding. Or it's, hey, I'm going to go buy a house in this beach town or somewhere that basically I'm just renting it by the week, which is very common or been common. What is your philosophy or what's your type of short-term rentals that you're looking at?
Right. We don't do arbitrage. So I've actually partnered with a couple people on 5 or 6 of them myself. And so we've done the more traditional method. I've done a hard money loan into it and renovated it and traditional refi out. Unfortunately, that doesn't work as well anymore with the interest rates. You're almost better off starting now, just getting a traditional loan. But yeah, so it's been those kind of 5-year holds. That's how we kind of picture it because we've been investing with other people to give them an out. I haven't done an arbitrage. It's a very cool model. And I would argue like right now, seller financing, assumption loans, arbitrage, they're all great methods to buy a property that you really don't want to lock in long-term debt. So great methods right now.
Yep. So you started with the duplexes. Like you mentioned, fast forward today, you're doing the Reg D 506C, which is a fund that accepts accredited investors. Why don't you tell us a little bit about how that's going, how you came to launching that, how long you've been working in the fund, a little bit more about that.
Yeah, for sure. So we have a Valkyrie Fund 1. We've done a lot of fund of funds before. So it's basically creating a fund or PPM per deal almost. We've had a fund of funds where we did it was open for 12 months and we did 2 deals in them, 2 syndications in them. Most of ours, though, are close-ended. This is the first open-ended fund considered. So we can have it continuously taking on investors up to a certain limit, but then they can cycle through as deals come through. And we can use this fund repeatedly, multiple deals. And so it's been good. It's education, talking about the difference between a fund versus just going into a single deal. The advantage for most people that they like is you get the 1K1, you get one paper PPM to sign, you have one portal login. I know a lot of people who are in 10 or 11 syndications in LP and they're logging into 5, 6 different portals. So a fund can be very useful to kind of consolidate that for the passive investor.
I'm waiting for somebody, which all the fintech companies out there, and I think you mentioned you use some IT stuff too, to create something that just is kind of like a clearinghouse for all the different portals. And somebody can just connect all of them like a bank. Same thing with your bank accounts. Why can't I have one place where I can see my Chase, my credit union, my Wells Fargo, almost to spread across the board? Do the same thing with your funds and almost pull the APIs from Juniper Square, AppFolio, and all these other places. And basically wow, here's one place. But it's interesting you mentioned that. I mean, it's genius the way you did that. And I did start it. So I'm on, I think, my 6th fund right now. And I did small funds up front that were closed because I wanted to test a lot of it. Okay, is it 2 years or 3 years? Is it better to give lower pref, higher upside, higher pref, lower upside, kind of see how the numbers worked, how much the fees were, kind of went through all these processes. And then I realized after the 3rd or 4th one, wait, I can do basically, like you said, create a fund and then just have different classes, which okay, for this 6 months, I'm raising money for this deal or these deals. Then I close that section of the fund and then just go to the next series. And it's a series within the fund that you can do. So like you said, you don't have to do all the PPMs, different filings, the Form Ds, register everything with the states every time.
Do you do a disclosure per asset class or is it they've signed everything from the start?
They signed everything from the start, but our asset classes will always notes. Our new fund, actually, we went through the Regulation A+ offering, which is the SEC qualification. So we now basically report to the SEC, good and bad. Well, I mean, the bad is it's just expensive to get everything set up. The good is you can solicit to anybody, accredited, non-accredited, it doesn't matter. So when you're looking at your investor profile, okay, there's X amount of accredited investors in your network or area or region or whatever, we have them. And of course, all the non-accredited investors we can have as well. Our minimum investment is only $2,500, so people can get in. And what we find a lot with that is people use that to test the waters and see how it goes and then come back and reinvest. So we got a lot of reinvestors. Lauren, my partner on this, today's the last day of the month, so she's manning the phones because all of a sudden everybody wants to because we issue monthly dividends. So it's end of month. Everyone's like, oh, let me get my money in today so I can invest so my dividend starts collecting tomorrow.
That's cool.
We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at 7E, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@70investments.com to learn more. Thank you.
So what have been some of the lessons learned, through your real estate investing career. And then second half of that question would be as part of managing a fund.
Yeah. So you don't know what you don't know. I think business is all about trying things out, tweaking it, changing systems. Real estate's the same way. You dive into a property and you're going to figure things out along the way to kind of circumvent that. So what I did is I learned along the way. So I spent 3 years trying different things. I think if I was going to recommend anything to anybody, and I'm not just saying this now because I have a course or something, but it's try to follow a framework, try to copy someone if you can. It'll save you a lot of headache, a lot of money. So if you can find someone who's, especially when you get into syndication stuff and you're getting into funds, you can spend a lot of money here and you can mess it up pretty good. But even if you're just buying a single family house and you undershoot renovations because you have no basis or no framework or no model or no person to copy, you can be like we did. We were under $40,000 for our renovations on our first deal. And I went to the bank and I got a 16% loan from USAA or Wells Fargo. I don't remember who it was. And I was like, dude, this better work. Yeah. So you can mess up a lot if you don't kind of follow a framework.
16%. Wow.
That was 2018, by the way, too. So
yeah. The other component I'd mention is with that, when you say, and as people scale and get into the multifamily and some of these other deals, if you undershoot the renovation, it's also costing you more time, which then your absorption rates change. And then once that starts happening, your whole model shifts and all those projected returns you have completely just get pushed. And all of a sudden that's when the snowball can really start picking up speed and going downhill.
Yeah. Holding costs are something that people don't really talk about, but that is what an experience, you'll figure out really quickly, experienced people are able to have lower holding costs because they know what they're doing and they can turn a property quicker or renovate quicker, which time is money. So if you are taking 6 months, or I know some people who they'll take 6 to 9 months to renovate a property. And I'm like, what are your holding costs? You're spending money for all that. So experience is key for getting holding costs down.
And I would tell anybody who's putting together any type of pro forma, always be conservative. Don't pencil it for the best case scenario because 99 out of 100 times that best case scenario doesn't work. I like to put everything down on paper and kind of write what I think everything's going to take and put it out before I start even plugging in numbers. That way it's okay, here are all my assumptions. Then your pro forma is your pro forma. You're not looking at it and be like, well, I think I can do better now to make the number look to the number I want it to be, because people always have that sense of, for some reason, it's kind of like getting an appraisal on a property you're going to buy. Wow, the appraisal came in just what I'm buying it for. Isn't that amazing? Oh, I think I can make 15% on this property or pay my investors 15%. On awesome pro forma comes in at 11. Well, if I just did this, it's 15. So, let me just do this. So that's the stuff you don't want to do.
Yeah, you can tweak a lot of stuff and make the paper look really good. But definitely, conservative is the best way to go. Then you have some room, some buffer to work with if you need to.
Yeah. And especially if you're buying any property that needs work, you should be the one getting that upside as a purchaser, not the seller. Your seller's why are you giving them all the upside of putting in the best case scenario for yourself? It's something that you should take care of. So for passive investors, what would be something, because you kind of wanted to get into this, be active, but after you looked at your 401k, not everybody should be a real estate investor. Not everyone should be active investors, but I'm a true believer. Everyone should definitely invest outside their 401k. We joke around here about the 40-40-40 club, 40 years, 40 hours a week for essentially 40% of your pay at the end of the day, which is not going to get you where you need to be. So what's some advice you would give to somebody who doesn't have the tenacity or the time really to be an active investor in the space?
Yeah, I did a post on LinkedIn. I'm big on LinkedIn as well. I post a lot on there. But typically, just a simple rule of thumb is if you're under 100K, you're probably better off finding a way to do it actively or with creative financing, really get after it. You can probably do better than giving up your last 25K. If you're between 100 and 200K salary, it's kind of your choice, depending on, do you like your job? Do you have a passion? Do you have a purpose? Or do you just not have the time? You have family, you have kids. That's really going to be your choice. And I'd say anybody with a $200,000 salary or more, really, you are making a good salary. You're probably pretty busy and you probably have a family. So you're almost better off just doing the passive investment route. You don't have to go learn everything. You can learn the basics and know what a good deal is or isn't, or what a good group looks like. Are they honest? Or do they have good updates and all that kind of stuff? You can know that without spending too much time on it. And you don't have to be an expert at real estate to invest in real estate. It's the same reason why you pay someone to mow your lawn or you don't do your own teeth, or you go to hire an attorney for a court case. It's the same thing in real estate. So you don't have to be the expert unless you want to, unless kind of like you fit those zones and you really want to.
Cool. So as we wrap up this episode, what would be some advice that you would be giving somebody just getting started or giving back to yourself when you started 5 years ago or however many years ago it was?
Yeah. I mean, the biggest thing people forget is like have a goal with a timeline. So find a strategy, pick it. Don't get annoyed, lost in the shiny. Find a strategy, pick it for 90 days, go after it. Whether the 90-day goal is just to learn about it or go do it, set your timeline, pick your strategy, copy someone or have a framework if you can. But that's what I see is the biggest mistake people do. They change their goals so much and they don't commit to anything. So get clear about your goal, commit to it and take action. That's really the key. I would tell anybody. Me too. It took me 6 months to even like start like actually making offers. So I was just like, yeah, I would underwrite, but I wouldn't make any offers. So
I did the same thing. I'd been in real estate for 20 years at the time, and I learned about note investing. And I spent 6 months spending time how to do everything. I built this crazy calculator to underwrite all the deals, and I'm underwriting all the deals. And I was too nervous to pull the trigger. And I'm like, my first trigger I pulled was basically like a $20,000 investment, which in real estate, that's not a lot of money. For me at the time, yeah, it's a lot of money, and 20 grand is a lot of money for people. But I was also watching people spend $10,000, $15,000 on a course. And I'm like, well, if I can spend 20,000 and learn the hard way, I knew I was going to lose everything, but okay, if I lost a few $1,000 on it, it's better, still great education, and I'm actually making money on those deals. So before we let you go, Chris, why don't you tell us a little bit more about you can tell a little bit about the fund. Is it still open? What's kind of minimum in investment strategy? And then a little about training and then people that you have, and then how people can reach out to you.
Awesome. Yeah. So if you are interested in being a passive investor, we have a fund. We invest in short-term rentals. We're investing in a 160 unit portfolio. We're one of the partners on this deal. So you can invest in a portfolio throughout the United States. $50,000 minimum, 16% return. It's accredited only. So that's how I can talk about it on here.
Yeah.
But great for passive investors. If you want to be active, just reach out. I'm on LinkedIn. You can schedule a call, 15-minute call. We can talk either way, passive or active. I'm here to help. So yeah, that's how I would suggest to get going.
Cool. And we will have Chris's contact information in the show notes for everybody to be able to reach out to him. So Chris, Thank you for being on this episode of Creating Wealth Simplified podcast. For all listeners out there, if you have not already, please make sure to like us and leave us a review at your favorite listening station. So Chris, thanks for joining us today.
Appreciate it. Take care.
Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show. Share with a friend or subscribe to the show and leave us a review.